If you're diving into real estate or running a side hustle from home, your home office could be a gold mine for some serious tax savings. In today's video, let's talk about how to maximize this deduction and keep more money in your pocket. We're covering all the essentials: who qualifies for this deduction, what you can deduct, and how to maximize every square inch for savings. And lastly, we'll talk about some common mistakes you want to avoid. If you're new here, hi, my name is Lydia, and I work full-time at the hospital, but on the side, I also run this YouTube channel, and I've got a couple of rental real estate properties. I feel super passionate that anyone in a similar boat should be aware of all of these tools at their disposal when it comes to taxes. That said, I am not a tax professional, and I cannot give you financial, tax, or legal advice. Use this educational video to help jumpstart your research. All right, disclaimers out of the way, let's jump in. Who qualifies for the home office deduction? Regardless of whether you rent your home or you own your home, there are 3 key requirements to claiming the home office deduction. The first one is exclusive use. You must use this place exclusively for your business, aka no personal use at all in this space. For those of you who are like me doing more than one thing, the IRS actually specifically states that you can use your home office for more than one trade or business activity, but you cannot use it for any activity that is not related to a trade or business. So I can film here and then later also use the same space to pay tourist taxes for my beach house. The second requirement is regular use. Regular, the IRS just defines as on a continuous basis, but there is not a specific number of hours per day or like number of days in a year as far as I could find. Personally, I use my home office at least like 5 out of the 7 days I'm either filming or editing or making a thumbnail or answering emails, meeting people, or looking at properties, doing admin and bookkeeping work, all sorts of stuff. So I'm pretty confident I meet the regularity requirement, but if you have more of a seasonal business or if your hours are more irregular just based on the nature of your business, I maybe just check with a professional to be sure. The third requirement is that it needs to be the principal place of your business. Unless you have some other office that you rent out outside, this should be pretty easy to satisfy. And it doesn't mean you can't do any business outside the home. Like sometimes my filming takes me outside the house. I also have to visit our rental property sometimes, but this is still the main space for my business activities. A space that fits all 3 of these criteria can be a home office for your business. And please note that it can be either a whole room if you have an extra room in your house, or it could be part of the room. Like this room I'm in right now is actually part of the master bedroom. It's just that on the side we have a lot of extra space where I can put my bookcase and my filming stuff and my desk. The IRS specifically states that it does not need to be marked off by a permanent partition. Let's go through the steps to maximize this deduction. The first step is to calculate the space that is your home office. The most common recommendation is to use the square footage of your space versus the square footage of your house. So take out your tape measure, or if you have like a floor plan from when you built the house, when you purchased the house, that might be even easier. Take the square footage of your office space and divide it by the square footage of the house, and that is the percentage of your home that is used as home office. This is the method that I'm personally using. The other method is to do it by percentage of rooms. So if your house has 8 rooms and your office is 1 of the 8 rooms, it is 12.5% by the room method. The fewer the total number of rooms there are in your house, the bigger the percentage is, and maybe it can be advantageous and lead to a bigger deduction. But double check what counts as a room. Generally, bathrooms don't count. You're counting like the bedrooms, living room, kitchen. But if you have like a great room, which is living, dining, and kitchen combined, is that one room? What if like dining space is kind of like a niche that's carved out? It has 3 of the walls, but not the 4th wall. It's still one like volume. Does this still count as a room? You might want to check with a professional to make sure you're doing this correctly. Step 2 is to decide what method you're going to use, whether it's the simplified method or the actual expenses calculation. The simplified method is just $5 per square foot of home office, regardless of the overall size of the house. I guess you didn't even need to know the percentage. At the time of recording, the maximum deduction using this method is $1,500. This method is great if you don't want to keep receipts and keep track of all sorts of records. And this is also the method I would choose if I didn't want to deal with recaptured depreciation taxed at a later time when I eventually sell the house. And I'll tell you more about that later. Generally speaking, the simplified method would give you a lower deduction amount unless you're in like a pretty low cost of living area and your housing expenses are really low. On the other hand, the regular method uses actual expenses. This is the method I use. It takes a little bit more effort in keeping track of expenses, but it can often result in a larger deduction. If you're not sure which method between these two to use, you don't have to decide right now. You can just save up all of your receipts in a pile, in a Google Drive, in an app. I personally use Stessa, which is a free app. I'll link it below. And I just upload everything as I go along because I can't be bothered with physical copies of little papers. It's better to have all the documentation and later decide you don't need it. When I'm talking about keeping track of expenses, there are three main kinds. There's direct, indirect, and unrelated expenses. Direct expenses are the ones that you incur directly related to the home office. Like if I needed to buy a new light bulb for the light behind me, that is the direct expense. Or it could be furniture like this desk or this bookcase. These would be considered capital expenditure or CapEx. These CapEx items can be purchased specifically for use in your home office, or they could be pieces of personal furniture that you're converting into business use. Instead of being deducted right away like other expenses like a piece of tape, an extra pen, or like the light bulb example, CapEx is depreciated over a number of years, like 5 or 7, depending on the item. Each year you would only deduct a percentage of that total cost based on the number of years. There are alternative ways to get more of that money up front, or even 100% of it deducted in that first year. For example, there's a de minimis safe harbor, which allows you to claim up to a certain amount deducted as just like a normal expense in the first year. There's bonus depreciation, which accelerates the depreciation. Even though it's phasing out, it's still a much bigger chunk up front. Or some CapEx items can be fully deducted within the first year under Section 179. This is where you really gotta consult with your tax person to figure out which one is more suitable for your situation, or even if you use a software like TurboTax, at least that can give you some guidance. You don't want to completely be winging this, and I'm just sharing all these options with you so that you know what questions to ask and what else to look into. For record keeping, here's what you'll need. For expenses, you'll need the date, the receipt, the amount, and especially if it's not super obvious how this thing is related to business, you want to note down like how this is a business expense. So for example, last year we purchased some gift cards for our tenants that are moving out because they've been wonderful tenants to work with and we just wish them all the best. Amazon gift cards are not really obvious what they were used for, so we would write down their names and why we gave them the gift. As for CapEx, your documentation would include how much you paid for the thing, like the bookcase was this many dollars, and you would also include any labor or delivery cost, and that goes into the basis of this whole bookcase thing, and together it depreciates as one sum. You'll need the date this furniture or piece of equipment was placed in service, and if it's a converted item from personal to business use like this desk, you'll need the fair market value of the thing on the day that you switched it over to business use. There are many valid ways to figure out how much the fair market value is, but one example would be if this were posted on Facebook Marketplace on that day, how much would it go for, or how much is a similar item going for at that time. The second kind of expenses is indirect expenses, and these are expenses that apply to the whole house. This is really where it gets a little bit annoying with all the record keeping, because you're talking all your HOA bills, the property taxes, the insurance, the property interest, and it's not like the escrow amount, like you need the actual bill for the insurance for that year for that property. You're talking about trash service, internet service, utility bills from every month. If the HVAC guy comes for a seasonal tune-up, that applies to the whole house. If you have a cleaner coming every week, every other week, that's another cost that is a whole house kind of indirect expense. The first year I did this was totally haphazard, but at least now I have last year's spreadsheet that shows all the categories and what amounts I had in each category, so that at least I can compare it for the next years and know I'm not missing something. For all these indirect items, you just deduct a percentage related to your home office. So for example, if like property insurance, taxes, HOA, all of those things that I just mentioned come up to a total of $25,000 for the year, and your home office is 10%, then your deduction is $2,500 for that year, at least for the indirect cost. The most powerful item I want to point out amongst these indirect costs is the depreciation of your house. For tax purposes, your home has a useful life, 39 years to be exact, and every year that you're using it for business, it depreciates by a certain amount. To use depreciation of your home, you first need to figure out the starting points, like how much your house is worth, also known as the fair market value of your house when you started using it for business purposes. Because this is a big number, I highly suggest confirming with a CPA what method you're using, but I'll share what mine told us. Our calculation was based on a recent appraisal that happened just shortly before we started using our home for business purposes, and our CPA also compared that with the county property records office. They have an assessment that talks about the fair market value and how many percent of that was the land, how many percent of that was the improvements or the building itself. Combining the county assessor records and the appraisal was kind of how we arrived on the fair market value of the house when we started using it for business, and it depreciates from that amount. The third kind of expense is the unrelated expense, and these are completely not deductible. For example, if I painted my living room, that is not my home office, obviously I can't deduct that. Or previously, we had guests staying at the tiny house, and related to hosting, we were paying for lawn services and snow removal. But since we don't host there anymore, that's purely a home office space where I sometimes do voiceovers where it's quiet. I can't really justify the snow removal cost as part of me using that space for recording a voiceover. Those are completely unrelated. Before we move on to common mistakes for the home office deduction, if you're enjoying this video so far, please consider subscribing and giving this video a thumbs up. It helps me know that this resonated with you, and it also helps the YouTube algorithm know to show you more of my videos in the future. So I really appreciate you doing that. All right, let's go to a few mistakes to avoid. The first one is not keeping records throughout the year. Don't set yourself up for failure by trying to scoop up your receipts very last minute and searching your Gmail for random expenses. Just develop a system, whether it's using an app or just keeping paper records or like uploading to a drive on Google. I hope that by watching this video, it gave you some ideas on what kinds of expenses to keep an eye out for so that you can gather your materials throughout the year. Mistake number 2 is foregoing the extra deductions. While it is true that the home office deduction can only be deducted against your profits, aka it can't take you into a tax loss, it can't be used to deduct against your W-2 income, it is still worth it to claim all of your deductions even if it is beyond your profit and you can't really claim it this year. That's because any excess deductions would carry over to a future year and to a future year after that if it still applies, and you can use it to offset any future profits. Nothing goes to waste, so you might as well just document all of it. The third mistake, and the most costly one, is not talking to a professional. When I first started, it kind of seemed crazy and disproportionate to hire a tax advisor or a CPA year-round for thousands of dollars because I haven't really even started making money, and it was this huge expense that I couldn't wrap my head around. Oftentimes, you can actually pay a CPA to review your situation and give advice, and pay based on an hourly rate. The couple $100s you spend here just one time to make sure you're set up for success is well worth the peace of mind that you've done it correctly. There are just so many nuances, like what is allowed, what is not allowed, how exactly to calculate the fair market value of the house. That's not something I would have figured out by myself. You probably have a few other tax questions related to your side hustles anyway. And as I mentioned briefly before, you may also want to ask about depreciation recapture and how it applies to you. The amount that you depreciate on your home, that later becomes taxable gain when you sell your house, even if it's your primary home, and it can be at the higher tax rate of 25% for capital gains. It may still make sense to take the depreciation because you are at a higher income tax bracket, you have self-employment taxes, there's a lot of state income tax, or in general, money now is better than money later, all sorts of valid reasons. Or upon hearing this, maybe you're thinking, well, simplified method makes more sense. I would avoid the whole depreciation recapture issue altogether. Maybe the difference wasn't that big in the first place. Why go through all that hassle to figure out which way is better? There are definitely more nuances to this than I can even imagine, and I don't know your situation, and there might be things you haven't considered before. This is why you really got to talk to a professional and make sure the decisions you make are in alignment with what you want for the future. I hope this was helpful. Please leave me a comment if you have other tips for home office deductions for the community, or if you have any questions. I hope you're having a great day, and if you want more tax-related tips, check out this video next.